Good afternoon, Matt, and good afternoon, everybody watching this interview. My name is Jonny Haycock. I'm a partner at Von Greyerz. For those that don't know me, I've been at the firm for just over 18 months. And I'm very excited about what we're starting here in terms of a long series of regular, short, snappy interviews with Matt Piepenburg, partner at the firm, Egon von Greyerz, of course, and a number of our advisors about prescient matters of the day related to the precious metals industry. Matt, so look, thanks for being the guinea pig and doing this first conversation with me. If I could just sort of set the scene. When Egon von Greyerz founded the business 25 years ago, he set it up with 6 or 7 core principles that many of our clients and many of his followers know extremely well. And those principles, of course, haven't changed one iota in 25 years. And they're very straightforward. They are, look, if you're going to own gold, you have to own it outside the banking system, in a private vault, in low-risk jurisdictions, fully insured, with direct access, and in your own name, and nobody else having legal claim over your gold. And those principles are as true today as they were 25 years ago. In this sort of 25-minute conversation, there are 3 areas that I want to touch on, and 2 of which, of course, are very relevant to those core principles. One, it is the risks of owning your gold in the banking system, and particularly in EU banks. 2, what makes a low-risk jurisdiction? And then finally, let's just touch on why understanding the macroeconomic environment is so critical to understanding why you should own gold. Those are the 3 areas I'd like to talk to you about. So let's just jump straight in with the first. And perhaps you could explain, Matt, just some of the lesser known risks out there that owning gold in a bank can come with. What are those risks?
Sure, Johnny. Thanks. And anyone who knows me, there's nothing snappy about my responses, but I'll do my best to keep this in our time slot. I think these are all really important themes. And look, for years, Egon and myself have been writing about the historical risks and this correlation to banking risk. And in particular, and we're really looking at a theme of increased centralization and control in general. And in simplest terms, as governments get more broke, they become more desperate. And this is always evidenced by increased centralization. And the evidence of which is literally all around us, from central bank digital currencies out of the World Bank, stable coins in the United States, digital IDs in the UK, wealth registries in the European Union, or just plain facial recognition boarding an international flight out of JFK or DC. So as nations go broke, we also see more financial repression. And that is usually actually when it's really kind of more comically when inflation is comically misreported and far surpassing interest rates or yields on government bonds. And of course, the slow drip of inevitable capital controls. These are all signs of centralization in general, is a general theme, which always follows debt-desperate sovereigns. As to banking risk in particular, we have written and warned for years about the otherwise unspoken pitfalls of holding precious metals in the banking system, which is a so-called strategy for many, but this strategy is just top-heavy with so much irony. One of the key reasons for holding physical gold or silver is its protection from systemic banking risk. And we've seen systemic banking risk as evidenced by the great financial crisis in 2008, or the recent 3 of the 4 largest bank failures in the US in 2023, and of course the Credit Suisse debacle that same year. So with this premise in mind, why would any serious precious metal investor wish to store a critical asset like gold within the very banking system gold is meant to protect you from? And commercial banks, as we both know, talk a good talk about gold and about allocated gold accounts. But allocated accounts are not separate from the bank's balance sheet. And this means your metals can be subject to rehypothecation by the banks, i.e. as collateral for the bank's own operations. So if a bank screws up, their collateral, your gold, is put at risk. And you are no longer really in control of your own metals. And global banks are subject to a number of gray and hidden legal frameworks, especially as you mentioned in the EU. And of particular note is the example of the bail-in legislation within the EU, and they call this the BRRD, or the Bank Recovery and Resolution Directive. And under this directive, Jonny, in the event of bank insolvency, regulators can impose bail-ins on bank creditors and depositors. And again, this means your gold accounts, even allocated accounts, can be included in assets taken from you to recapitalize the banks. And some would say, yeah, that's a slim risk. Banks are too big to fail. But we know there's not zero risk here. And this is why serious gold investors have to be held in allocations by serious gold investors really have to be held outside this really trembling, fragile banking system. Again, the cracks of which we've seen over the years. So they can control as many risks as they possibly can. And again, many see convenience in the banks. They are to some extent too big to fail or too powerful. We couldn't see risk, but the evidence says otherwise. So they see the convenience in the banks, but they ignore the control they are surrendering and the risks they are taking. In other words, some are currently preferring really the convenience over control. And truthfully, or thankfully, many more investors are recognizing banking risk now, especially in the post-2023 or even the post-2008 world. And this explains, Jonny, why sophisticated investors, as you know, family offices, high net worths, managed funds, et cetera, especially post-Credit Suisse, are moving to private vaults in politically neutral jurisdictions where legal ownership structure for their precious metals are entirely outside of the banking sector. And this is in jurisdictions like Switzerland, Singapore, and of course, Dubai is making headlines too. But again, to conclude, that's why jurisdictional considerations are probably just as important as banking awareness and banking risk awareness.
We're going to come on to the jurisdiction piece in a second, but can you just elaborate a little bit more on the EU directive specifically? Because that is obviously important, given that, our business and vaults are in Switzerland outside of the EU.
Well, that's one of the things we'll talk about with jurisdiction, because you want to be outside of that juggernaut of bureaucracy, which is the European Union, out of Brussels. It's a bureaucracy that would make the Soviets blush. It's even more extensive. And I think the banking regulations in the EU are particularly onerous, particularly centralized. And believe me, the US is not far off. And again, this is the great theme of the great taking. What do you really own, whether it's at a brokerage account, whether it's in a large commercial bank? When these institutions fail, the assets that you think are yours are actually the assets of the bank first and the client second. And this goes way past Glass-Steagall discussions. In Europe, the regulations are a little more onerous. They're more out in front of you. In the US, they're a little more gray and hidden. But the bottom line is, if a bank has a true failure, like we saw in 2023, which the FDIC or the government doesn't bail out, you could have a scenario, again, as Egon and I have discussed, slim, but the fact that it's existing at all is reason enough to be concerned. You could have a scenario where you're in second or third line behind your own assets. And again, they're not really yours once they fall under the umbrella of these banks. And if these banks get over their skis in something nefarious, something leveraged, something where they're caught at low tide naked, so to speak, your assets, and especially your precious metals, are not sitting there waiting for you when you need them, especially when you need them most. That's the risk. Again, some would say it's slim, but this BRRD narrative and recovery Resolution Act is concerning. It's not surprising. It's more in the surface now in the headlines, but it's really these kind of bankruptcy laws or insolvency laws and banking regs have really been in place for years. They're just getting more attention now as the world gets more desperate. Many investors, even serious investors, are still unaware of these risks. And again, we're not saying banks are all going to fail tomorrow, or the JP Morgan's going down, or any of the large banks are. But we've seen headlines in the last 3 years that would have shocked us 10 years ago. And we've certainly seen headlines in the last 15 years that would have shocked us 20 years ago. We're not arguing that banks are going to fail. We're arguing there's a risk they could. And if they did, that's the last place you want to hold large sums of precious metals. Because again, the irony is you're holding precious metals for many reasons. One of them is banking risk. Why would you then store these metals in a bank, the very system you're trying to protect yourself from?
So what you're saying is, within the fine print, there is some detail here that most are unaware of. And
very much.
Ultimately, why take any counterparty risk when you don't need to? Yeah, that's the point. Okay, that's great. I want to touch a little bit on financial repression in a second, but this is a good segue to move on then to why Switzerland differentiates itself from the EU. Can you just touch on that?
Yeah, again, jurisdiction has always been a key consideration of Von Greyerz, and it was fundamental to Egon's selection of Switzerland for the entire enterprise decades ago. And clearly, we all, including Egon, have a bias for Switzerland and also Singapore to some extent, of course. But it is a bias really built upon extensive research. And for anyone listening, I highly recommend the white paper that we prepared on our jurisdictional comparisons, again, from Panama to New Zealand. It's prominently posted on the Why Gold page that we have on the website. And there's a whole long, lengthy discussion of the pros and cons of different jurisdictions for holding precious metals. But, before getting into the broad comparisons of zip codes for jurisdiction, a certain key location and service questions or characteristics need to be examined at the 30,000 foot level for anyone who's making serious, investments in gold. Severe in the sense that there's a lot of risk, there's a lot of money in place. We have very high minimums, as you know. And so these are particularly important when you're making large allocations. But these things really apply to anyone looking to store physical gold outside of a Folgers can. And the first thing is clear to us. It's you need a legal firewall between your gold and your respective government, whether you're in the UK, the US, Austria, Germany, etc. It's really for a number of reasons laid out in these articles. We spell out why it's critical to have your precious metals, your tier one, reserve asset held outside of the system under your own government's control because of problems within your own government. And they're different jurisdiction to jurisdiction. The other key consideration, regardless of whether you're looking at Von Greyerz or Switzerland and just looking in general at private vaults, is the reputation of the jurisdiction and the vault provider themselves. At the jurisdictional level, does that country possess a clear history of political and legal stability? Does it have a tradition of gold storage? Is it free of vulnerable alliances or controls? In the EU, for example, whether you're in Dublin, Amsterdam, Berlin, or Paris, those regulations float through all those jurisdictions, and there's a lot of controls and alliances. So you're not safe just because you're in Austria as opposed to France. U.S. has tremendous influence over Canada and storage there. So these are things that are more spelled out there, but these are things you need to consider. The reputation at the jurisdictional level. At the service level, does the private vault have a true history? Has it been in business for 10 minutes, 10 years, 30 years, et cetera? Is it focused exclusively on precious metal storage, or is it doing other things as well? Does it have a trading desk for acquisition and sales? Does it have insurance or decent insurance? What's its IT or client security? Does it have access 24/7 to account management? Does it provide transport? Is the vault above ground or is it bedrock protected? What's the expertise of the management? Again, these are broad questions that apply regardless of what jurisdiction in particular. It's the actual service reputation. And then there's the vaulting facilities in general. Panama, for example, has very good tax and privacy regulations, but very poor vaults. In a worst case scenario, you don't want millions or large amounts of your gold and silver in very shoddy above ground vaults. Now, Switzerland is the most known gold hub for a reason, Jonny. It's the gold capital of the world, as you know. It has a massive trading and refining and storage infrastructure. 70% of the gold bars in the world are refined here in Switzerland. Gold accounts for 29% of Switzerland exports. So again, what this means is it makes precious metals a very protected industry in Switzerland. That's very critical. And central banks have gold, but Switzerland's central bank ownership of gold is really one of the world's largest per capita. It has a global reputation as well for political neutrality, which isn't perfect, as we saw in the Ukraine sanctions, but also has a real strong reputation for political stability and direct democracy and a massive respect for the rule of law. These are critical things that make Switzerland stand out, I think. And Switzerland enjoys, as I mentioned earlier, independence from this massive EU bureaucracy out of Brussels. And of course, Switzerland has an international reputation for its superior privacy laws and a financial system that allows free-flowing currency without limits. Now, again, privacy laws in Switzerland, and certainly at Von Greyerz, doesn't mean it's meant to hide secrets. It's meant to protect privacy. We still have in Switzerland, and certainly at Von Greyerz, anti-money laundering and KYC, know your client protocols that we stick to very, very importantly, very clearly. But again, privacy is a respected value that Switzerland, I think, gives more credence to than almost any other jurisdiction. And one thing that's unique about certain companies, certainly Von Greyerz, when you're storing gold in a place like Switzerland, is that we're a 100% owned Swiss company. And operating within Switzerland, that's very different than a foreign entity operating in Switzerland, because we have advantages that foreign entities don't have. In particular, a foreign entity operating in Switzerland is still subject to the laws of its home country and the regulations of its own country. We know our regulations within Switzerland better because we're housed in that jurisdiction and we're a Swiss-owned company, and that has a lot of advantages. We know exactly the smoke and the mirrors and the clarity within the jurisdiction that foreign entities operating there just don't enjoy or understand. in terms of, and I won't go through the list extensively, but obviously Singapore has similar kind of characteristics that we respect, especially for our clients, whether they're expats or locals in Asia. Singapore has a lot of the same advantages as a major gold hub in Asia. New Zealand is another classic example. It's got great fee and security advantages, but it's subject to the Five Eyes network, which means that US, the UK, Canada, et cetera, they exchange information between each other. So you don't have that kind of privacy that Switzerland has. The Caymans, another great jurisdiction for privacy, but subject to UK regulatory impositions. That's just a known fact in the Caymans. Another known hub is Hong Kong. We've looked at extensively. It's a massive finance hub. It has really good fee comparisons, but it's under tremendous pressure from China. To us, that's a very high geopolitical risk. And finally, of course, there's the United States, my home country. It's fiscal instability, monetary instability, political instability, and the banking regs are off the charts. These are all known facts to Americans and non-Americans alike. And more importantly, the U.S. has a severe history of control, not just with gold in 1933, but in general with capital controls and repression and misreported data. So again, jurisdiction is a long, long topic, but those are just some examples of the key things we're looking at and some of the reasons we still think Switzerland, in particular Singapore as well, are superior.
Thank you. And look, just touching on sort of as the pips start to squeak in terms of, debt-soaked nations, clearly, the UK has its issues, obviously with a gaping deficit, as does France. These are well documented.
Yeah.
Are there any signs that we should be looking out for to see how, the risk of capital controls or financial repression is becoming a more live issue? Is there anything any pointers that you would allude to?
There's so many. It's a 30,000-foot level is just history. And again, we won't go into the weeds, but throughout history, without exception, when countries go broke, they increasingly become more desperate, and capital controls and financial repression become very much the norm. It's nothing new to history. It's nothing new to this particular time we're in. The type of capital controls we're seeing now, the most obvious financial repression, as I indicated at the top of the hour or the top of the interview, really is when you misreport inflation. Again, if we use the same inflation in the U.S. that Volcker used to fight inflation, if we look at the CPI scale, it would put inflation in the U.S. We use the same scale we used in the 80s. It would put quantifiably and objectively inflation at 10 to 11% in the U.S. If you're getting yield from the short end of the curve of the Treasury and the bills all the way to the 30-year Treasury, between 4 to 5 or 6% yields, you're not beating inflation. So you're actually getting a negative returning bond. To me, constructively, that's a defaulting bond, but they're not reporting inflation accurately. So you're actually getting no return across the risk structure of U.S. sovereign IOUs. That's an appalling form of misrepresentation. That's an appalling form of running negative real rates, but not talking about it. In terms of capital controls, look, stablecoin, these are trackable, highly programmable e-dollars, which are no different than a central bank digital currency, which is meant to track and control your money, in particular. In a worst case scenario, as we saw in Canada with the truckers, these are headline examples. There are certainly more subtle examples, but if you or I write the wrong thing, say the wrong thing, believe the wrong thing, or don't toe the line, technically a stablecoin is far more easy to control than a bar of gold held in a private vault in Switzerland. So between financial repression, stablecoin, central bank digital currency, misreporting inflation, misreporting recessionary data, hiding the data, shutting down the data, the list is long. And their list of long of banks that have been unable to deliver assets or leveraging assets without transparency, particular private precious metals, is also long. Well, that would take a separate hour. But again, these are all examples of cracks in the ice that are not meant to be sensational, but are hiding in plain sight.
Yeah, and look, my personal view is, look, we all know that the world is becoming more digital, and the more the world does become digitalized, then actually the more valuable having your insurance that you can touch and feel, your physical gold, your physical silver outside of the banking system, the more valuable that becomes. Just conscious of time, Matt, let's just move on to the third and final piece, and just a couple of minutes, if you would, on why understanding the bigger picture macro themes is so critical to understanding why gold is experiencing such a tremendous run at the moment. We're speaking obviously at a very timely moment, given the pullback that we had in the gold price earlier this week. But why is it that understanding, two or three of the biggest macro themes is so critical in educating investors to allocate just a percentage
Sure.
of wealth to gold?
Well, look, it ties into our services and our conviction. I mean, I'm not really giving a thesis. God knows people have heard my macro views for years. They don't want to hear that here. They just get it anywhere. But tying the big picture market forces to direct knowledge of gold forces is really important. And our services is built upon a core understanding of gold. And from there, the optimal ways to acquire gold, store gold, transport gold, insure gold, provide liquidity from it, et cetera, when needed. But again, all of these arcs to the services really stem from a fundamental understanding of and a specific focus on gold. And understanding gold means its role in the context of the broader financial markets in general. I mean, this is from equity and credit markets, stocks and bonds, to banking practices, to sovereign debt swaps, central bank mechanizations, currency moves, and as important, I think, history itself. So, when it comes to our service, we've been correct for decades. And I say we, Egon in particular, and you and I coming in later, we've been correct for decades about gold's rising status as a real money strategic reserve alternative to openly embarrassed fiat currencies. And we've been confident for decades about gold because we see these forces. And this has nothing to do with a vindication of recent gold headlines about 4,000 or the volatility intraday in the last couple of days. In a bull market, there are always dramatic pullbacks. They fall quickly and then recover. But gold doesn't move in a straight line. And this is no hubris apex for us or a schadenfreude, I've told you so moment when gold is hitting all-time highs. We've been consistent about our message for years when consensus was openly against us, even as gold was openly outperforming the S&P for a quarter of a century. And while U.S. Treasuries have been the worst asset in the last 5 years, the mainstream financial media and Wall Street narratives have deliberately and woefully misunderstood and I think misrepresented gold and the forces ensuring its secular rise, all of which we've been staring at for years. And it all comes from a debt crisis. When there's a debt crisis, you monetize that debt with debased money. But this non-consensus confidence doesn't come from being kooky or being contrarian or gold buggy. It actually comes from years and years of really deep and direct trading experience, banking experience, and family office experience shared by all of our partners. And again, folks like Egon and myself, you, Ronnie Sturfula, Alistair, who you'll be speaking to, Alistair McLeod, are not content creators. An article or an interview like this can be written or recorded in a matter of hours or minutes. But what makes that content valuable are the decades of work and experience, perspective, and lessons behind it. And this means really, Jonny, a deep fluency in the macroeconomics and the financial history, as well as the micro understanding, the kind of the in the trenches combat experience we have with markets, from risk assets to the tricks played by the COMEX, the signals from currency moves, yield curves, et cetera. All of this we've earned as partners and as participants in this market, in which we've then translated into a deeper and specific expertise in gold, which no AI program can match. And this is important because when clients are trusting groups like us with millions of personal income, they need more than a robot on the call or screen when they have questions or concerns. They need market veterans who have the luxury of speaking precisely what they think. And you and I both know that working for a large bank means your message is constrained by the views of that institution, which is totally normal. At Von Greyerz, we don't have such constraints. That's, I think, what really makes our outlook so unique and our team so unique, because the team seen by the public, and as importantly, the team behind the curtains, really have this tremendous expertise. What we do at the trading desk, for example, no one sees on YouTube or on these interviews. What we do with client interactions, our vault visits, the IT security we have, it's all industry leading and it's all managed by extremely qualified partners and the teams and tasks that they manage, which are behind the curtains. So we are far more than content creators. We are far more than gold bugs. We are blunt veterans of a complex market who understand gold's historical, current, and future direction because we understand the larger kind of hermeneutics of the markets. And I'll end with this. I mean, just look at Egon as the example. I kind of joke that this must be the Virginian part of me. He's the Stonewall Jackson of the gold space. I mean, he literally stands there with this conviction unmoving. He bought gold at 300. He never panicked running Von Greyerz when it was during the consolidation phase between 2011, 2024, nor is he enjoying some I told you so lap around the track. When gold passed 4,000, he never needed to look at the price. In all the years I've known him, before I joined and when I was watching him, he never needed to look at the price because he always trusted the history and the math and the direction of bond markets and the direction of currencies in the direction of gold, because gold simply holds its value better than paper money. It always has, it always will, whether it's at 4,000, 8,000, 12,000, or 20,000. Egon has never looked at the price, never worried about the price, has always had that Stonewall-like conviction. It's been a huge advantage to me to have a mentor like that. We all know that. And that ethos passes down to all the partners at Von Greyerz.
Yeah, they look absolutely. And as he tells us every day, we haven't even started yet.
No,
so,
exactly.
Matt, listen, I'm gonna pause you there. If I could just sum up, what you're basically saying is, one, don't underestimate the risks in the financial system. We've seen those risks surface over the last 2 decades on a pretty regular basis. Don't take counterparty risk if you don't have to. 2, do consider the jurisdiction within which that you own your gold. There are huge differentiations across continents and across countries. And Switzerland and Singapore, in our view, are still the best 2 jurisdictions in the world to be holding precious metals. And finally, when you're investing in gold and silver, ultimately you're investing in the people that you are entrusting your money to buy your gold and store it in the most secure locations and most secure vaults with people that understand the market. And frankly, it's an asset class that is still very misunderstood today. Would you say that's a fair summary?
Absolutely a fair summary. Very good, Jonny.
Perfect. Well, look, it's meant to be short and snappy. Thank you very much, Matt, for your time. Let's do this again some other time.